Is the latest massive market surge in quantum computing an undervalued, once-in-a-generation buy? Or is it just a flashing sell signal value trap that's about to completely crush retail investors?
Yeah, I mean, that is the multi-million-dollar question the market is trying to price in right now, like in real time.
Exactly. And the data we're looking at today is just genuinely
Yeah,
polarizing
oh, absolutely.
because on one side you have this newly announced partnership with Nvidia and, an underlying technology that could literally reshape global computing.
Right. The upside is massive.
But then on the other side, you have a company trading at a price to sales ratio of 2,500, and they are burning through over $60 million a year.
Yeah, the math it's pretty staggering when you actually look at it.
It really is. So we are pulling from a big stack of fresh financial data, SEC filings, technical analysis reports, and market order flows centered entirely around one highly explosive stock today.
Xanadu Quantum Technologies Limited.
Right. Ticker symbol XNDU. And our mission for this deep dive is to essentially cut through all this extreme daily volatility, examine the cold, hard financials behind the hype, and really weigh the bull and bear cases.
What to the bottom of it?
Exactly. But before we rip into these balance sheets, do us a quick favor. Make sure you like this video, subscribe to our YouTube channel, and you absolutely must leave us your feedback in the comments section below.
Yeah, we want to know exactly where you stand on this debate.
Because it is a heated one. Now, right at the top, I think we need to establish a very clear baseline here.
Yes, definitely. Just a quick reminder that this deep dive is purely an educational analysis of the financial filings and the natural market debate surrounding them.
Right.
We were just examining the source data, the technical indicators, and market psychology. Absolutely none of what we're discussing today is financial advice.
Period. You always need to do your own independent research.
Yeah.
So to figure out if we are looking at a trap or an incredible opportunity, I feel like we have to start with the sheer physical scale of what happened to XNDU's stock price today, because the numbers are, well, they're staggering.
It's been a wild ride, yeah.
As of midday today, April 16th, 2026, shares are trading at $48.59 Canadian on the Toronto Stock Exchange.
And that's about $37.39 US on the NASDAQ.
Right. And that is a 41.13% surge just today alone.
Just today, which is wild.
It's nuts. And zooming out just a bit, we are tracking a bullish trend of over 349% year to date.
Yeah, and to really understand the magnitude of that, you have to look at the 52-week range in the historical trading data.
Okay, lay it on us.
Well, the 52-week low for this stock was just $6.97.
Wow.
Yeah. And compared to today, it hit a brand new all-time high of $51.15.
That is just, I mean, a swing of that size in a single year usually requires a massive fundamental shift in how the market values the company's future, right? Or maybe just a massive anomaly in market mechanics.
Exactly. It's rarely just a typical organic growth curve.
Which naturally leads to the question of who is actually driving all this volume. Like, are we just looking at retail traders organizing on social media to pile into the next shiny tech ticker? Or is there, real institutional money fueling this run?
Well, the midday order flow data is really interesting. It shows a volume of 323,521 shares on the TSE.
Which is drastically higher than their historical average.
Oh, completely. And what the filings tell us is that this is a highly volatile mix. I mean, there's heavy retail buying pressure, absolutely.
You'd expect that with a quantum stock.
Right. But there is also serious institutional backing. Institutions currently hold 17.50% of Xanadu.
Wait, really? Almost 20%?
Yeah. And we aren't just talking about specialized, venture capital funds that just throw money at anything with the word quantum in it.
Right, the usual suspects.
We are seeing positions from heavyweights like OMERS.
Wait, hold on. OMERS, the Ontario Municipal Employees Retirement System.
That's the one.
But OMERS is a massive pension fund. Their entire mandate is usually about capital preservation, keeping municipal workers' retirement safe with boring, reliable dividend stocks and bonds.
Usually, yeah.
Why is a conservative pension fund taking a piece of a 17% overall institutional block in a hyper-speculative, pre-profit quantum computing company?
It's a great question. And it's because in the modern market, pension funds are facing a really severe yield problem.
Ah, right. The bonds aren't paying out like they used to.
Exactly. Safe bonds just don't return enough to cover the massive demographic wave of retiring workers. So funds like OMERS carve out a specific percentage of their portfolio for deep tech, high-risk, high-reward plays.
They need that alpha.
They do. They are looking for asymmetric returns.
Yeah.
If a company like Xanadu fails, well, it's a small dent in a multi-billion-dollar portfolio.
Barely a rounding error for them.
Right. But if it succeeds and becomes the foundational architecture of the quantum internet, it generates the kind of exponential returns that can literally float a pension fund for a decade.
That makes a lot of sense. And speaking of people who want exponential returns, I was looking at the recent insider trading reports in the filings.
Oh yeah, the founder activities.
Yeah. The public filings show that Xanadu's founders are holding on to their Class B shares with 0 major sell signals reported during this whole 350% rally.
Which is incredibly telling.
Right? Because human nature dictates that if your net worth just jumped 350% on paper in 4 months, you take some chips off the table.
You'd think so. You secure the bag.
Exactly. The fact that they aren't selling a single share, I mean, is that supreme, unshakable confidence in the tech, or are they legally locked up from selling right now?
Well, looking at the filings, they don't explicitly cite a current lockup period forcing their hands right now.
Oh, wow. So they could sell if they wanted to.
They could.
Yeah.
So the market interprets this lack of insider selling as a massive signal of conviction.
I bet.
When the architects of the technology refuse to sell at $51, retail investors see that and assume the founders believe 51 is still drastically underpriced compared to where the tech is going in, say, 3 years.
They see it as a new floor, not a peak.
Exactly.
But, I mean, confidence only pays the bills for so long. Eventually, you have to turn on the lights and pay the engineers.
That is the harsh reality.
And when we actually open Xanadu's books and look past the daily stock chart, that confidence seems, frankly, entirely disconnected from the math.
Let's dig into that. Let's look at the trailing 12 months or TTM fundamental data.
Yeah, because the contrast on the income statement is genuinely hard to wrap your head around.
It really is.
Looking at both the quarterly and annual trends, their annual revenue is sitting tiny between $3.45 million and $4.62 million.
Right. Small potatoes.
But the net income is a massive bleeding loss. I'm seeing it ranging from negative $58.49 million to negative $70.67 million.
Yeah.
And earnings per share sits between negative 15 cents and negative 21 cents.
Now, if you apply traditional value investing metrics to those numbers, the stock is completely uninvestable.
Oh, 100%. A $70 million loss on $4 million of revenue is a disaster for a mature business.
But that's the key, say. Xanadu isn't mature. It's in a pre-profit, deep tech incubation phase.
Okay, so where is all that money going?
That massive net income loss isn't from, operational inefficiency or bloated management. It's driven entirely by immense research and development spend.
Oh, the science.
Exactly. Building specialized quantum hardware and paying top-tier PhDs in quantum physics is astronomically expensive.
I want to make sure we are visualizing this dynamic accurately for the listener. It's almost like a team of engineers building a $1 trillion revolutionary hypercar in a garage, right?
I like that analogy, yeah.
They are burning through tens of millions of dollars a year, inventing this engine that runs on a completely new kind of physics. But right now, today, their only actual tangible revenue comes from selling keychains with the car's logo on them in the lobby.
That's spot on. The revenue from their current early-stage cloud access is essentially the keychains, yes.
Right.
It's negligible compared to the capital required to finalize the actual product. And when you look at the balance sheet to see how long they can survive this burn rate, the tension becomes very clear.
Yeah, let's look at the cash flow and balance sheet.
So total cash sits at $36.11 million against a total debt of $34.28 million.
Which means they have just enough cash on hand to cover the debt. That sounds incredibly dangerous.
It's tight.
If the rent comes due on the garage and keychain sales don't cover it, what happens? Are we looking at a ticking time bomb here?
Well, you have to look at their current ratio to answer that. It sits at 5.34.
Okay, break that down for us.
The current ratio measures a company's ability to pay its short-term obligations, basically anything due within 1 year.
Got it.
A ratio of 5.34 means they have over 5 times more liquid short-term assets than short-term liabilities.
Oh, okay. That's actually pretty solid.
It is. So they aren't going to miss a payroll or default on a loan tomorrow. But, and this is the massive caveat, their operating cash flow remains deeply, deeply negative.
So it's still a ticking clock, just maybe a slightly longer one than it looks at first glance.
Exactly.
If you are losing $60 million a year and you only have $36 million in cash, basic math says you run out of money in roughly 7 to 8 months unless you get an infusion.
Right. You are entirely reliant on external capital. You have to keep convincing the market or private equity to give you more money to finish the machine.
Which brings us to the most perplexing part of this entire deep dive.
The technicals.
Yes. If the company is actively bleeding $60 million a year with a very finite runway, why in the world are the technical indicators screaming buy?
It's a huge disconnect.
Let's really get into the technical analysis in the latest news because there is a massive debate happening on trading floors right now. Is XNDU genuinely undervalued? Or is this a textbook value trap?
Well, the technical data tells a story of relentless, accelerating momentum. Based on moving averages, XNDU is flashing a strong buy.
Strong buy with those financials.
Yep. It is currently trading so far above its historical baselines that it almost looks like a glitch on the chart. The 50-day moving average is all the way down at $8.38, and the 200-day moving average is at $3.45.
So a stock that historically lived in the $3 to $8 range has violently relocated to the $48 range.
Yes. And the moving average divergence sits at 1.060.
And for those who don't day trade, what does that actually mean?
The MACD isn't just a squiggly line on a chart. It measures the relationship between a short-term moving average and a long-term one. When the short-term average aggressively pulls away from the long-term average, it mathematically confirms that the upward momentum is accelerating right now.
It's a clear buy signal for trend traders.
Exactly. And looking at the latest data, we are seeing immediate support levels form at $36.50, which was today's intraday low, and $29.50, which was the open.
Right. And then the immediate ceiling, the resistance, is that $51.15 psychological barrier, the high it just hit.
Correct.
But, I mean, trees don't grow to the sky. Stocks don't just go up in a vertical green line forever without consequences. There has to be a physical limit to how many buyers are left. What are the negative signals here?
And that is the massive downside risk right there. The 14-day RSI, the Relative Strength Index, is currently sitting at 72.80.
Break that down for us, because an RSI over 70 is universally known as the overbought zone. But what does that actually mean for the person holding the stock right now?
An RSI over 70 tells us about buyer exhaustion.
Okay.
Imagine a literal tug of war where the bulls have been pulling the rope relentlessly against the bears for weeks. They are winning, the rope is moving their way, but eventually, their arms just get tired.
Yeah, they run out of steam.
Exactly. There is simply no one left on the sidelines with fresh capital to jump in and keep pulling. When you run out of marginal buyers, even a tiny amount of selling pressure causes the rope to snap back violently.
Oh, wow.
That is what an overbought RSI signals. The underlying trend might be real, but the current sprint is physically exhausted.
I was actually reading an analyst report this morning, and the consensus rating is still a strong buy, but the specific price targets from Wall Street are actually lagging way behind the current $48 price point.
Which is pretty common in a run like this. The price is just moving faster than institutional analysts can update their financial models.
Oh, so they literally just can't type fast enough.
Pretty much.
Yeah.
They simply cannot issue revised, peer-reviewed reports fast enough to keep up with the stock surging 40% in a single trading session.
Which creates a fascinating but terrifying metric. The price-to-sales ratio?
Oh, yeah. This is the wild part.
XNDU is trading at a PS ratio of around 2,500. Just let that sink in for a second.
It's astronomical.
For every single dollar of current revenue, for every keychain sold, investors are paying $2,500. For context, a wildly successful, highly profitable tech giant might trade at a PS ratio of 5 or maybe 10. A ratio of 2,500 means nobody's paying for the company that exists today.
No, not at all. In deep tech investing, you aren't really buying a company. You're buying an option on a future monopoly.
A monopoly insurance policy, basically.
Exactly. If Xanadu's technology becomes the global standard, they don't just capture a percentage of a market, they become the foundational toll booth for the next era of human computing. That 2,500 multiplier represents that monopoly insurance. And this is exactly where retail traders get trapped.
How so?
They see the momentum, they see the green candles, and they buy in without understanding that they're paying a massive, speculative premium for a future that hasn't even been built yet.
So we have an exhausted RSI, a mathematically guaranteed need for cash, and an astronomical valuation premium. To figure out if this snaps back into a value trap or if it justifies the premium, we have to look at the catalysts.
Yes, the bull versus bear case.
Exactly. We have to look at the actual physics and business strategy driving the bull case. Best case recovery scenario, what are we looking at?
Well, the bull case, the scenario where they recover from any short-term weakness and continue to grow, rests on three massive pillars in our sources. First, Xanadu recently announced a major partnership with Nvidia for photonic quantum computing.
Wow. In this current market environment, associating your architecture with NVIDIA is basically being anointed by the tech gods. It's the ultimate validator.
It really is. It signals to the broader market that your underlying technology integrates with the most powerful AI and data center infrastructure on the planet.
Huge. What's the second pillar?
Second, Xanadu operates a software platform called PennyLane. And according to the data, PennyLane is rapidly becoming the industry standard software library for quantum machine learning.
So they aren't just building the hardware, they are trying to build the operating system. It's
Exactly.
like trying to invent Windows before the personal computer is even sitting on everyone's desk.
And the genius of that strategy is the concept of switching costs.
Right.
If you give the software away to universities, and an entire generation of developers learns to code quantum algorithms exclusively using the PennyLane library, the switching costs to move to a competitor system later become incredibly high.
They're locked in.
Yep. If you own the software ecosystem, you control the demand for the hardware. And that leads to the third, most critical bullish point, their first mover advantage in photonic architecture.
Right, because most of the legacy quantum computers we hear about from the major, legacy tech companies, they rely on superconducting methods.
Exactly. And superconducting qubits are incredibly sensitive to environmental noise.
They need it to be cold, right?
Very cold. To make them work, you have to place the quantum chip inside a massive dilution refrigerator, cooling it down to a fraction of a degree above absolute zero.
That sounds expensive.
It is. You're spending millions of dollars just fighting ambient room temperature. But Xanadu's photonic architecture uses particles of light photons.
Okay.
And photons don't care about ambient heat. They can travel through standard fiber optic cables at room temperature.
Oh, wow. So the physics fundamentally allow for scalability. You don't need a custom-built sub-zero bunker. You just need light.
Precisely.
I completely see why the market is aggressively pricing in a monopoly. It literally sounds like science fiction becoming reality.
But as always, we have to balance this with the grim realities of the bear case.
We do.
Let's outline the worst-case continuation lower. The bear case requires no imagination because it's rooted entirely in gravity and immediate financial constraints. First, as we covered, the extreme overextension on the technical charts means a violent pullback is highly probable as early buyers take profits.
Right, that rubber band snapping back.
Yeah. Second, the $60 million annual burn rate.
And this is where the whole first mover advantage thesis hits a brick wall, isn't it?
It really does.
Because if they're burning 60 million and they only have 36 million in the bank, a future capital raise isn't just a possibility, it's a mathematical certainty.
They had to raise money.
They are going to have to issue millions of new shares to raise more cash. And when they do that, the current shareholder base gets diluted. Your slice of the pie shrinks.
Exactly.
If they run out of cash and have to raise capital under unfavorable macroeconomic conditions, does being the first mover in room temperature quantum even matter?
It is a brutal historical reality in the tech sector.
Yeah.
Being first to invent the tech doesn't mean you are the one who survives to monetize it.
History is littered with companies like that.
Completely. If current shareholders are heavily diluted to keep the lights on, then even if Xanadu achieves global dominance 10 years from now, the people buying at $48 today might never see a return on their investment.
That is the definition of a value trap. The technology succeeds, but the stock structure fails the early investor.
Well said.
So how do we synthesize all of this? If I'm looking at this chart tomorrow morning, what is the actual outlook, like short-term versus long-term?
In the immediate short term, so the next few days and weeks, expect brutal, choppy volatility.
Buckle up, basically.
Yeah. Given the RSI showing buyer exhaustion, there is a high probability of consolidation. We will likely see weakness drag the price back to the $40 to $45 support range as the people who rode a 349% wave decide it's time to cash out and, buy a house.
Secure the bag.
Right. But in the medium to long term, the daily wiggles on the chart are irrelevant. Survival and justifying a PS ratio of 2,500 depends strictly on hitting their hardware milestones.
They have to deliver.
They have to prove fault-tolerant computing works at scale, and they have to successfully monetize the PennyLane cloud services.
They have to finally start selling the hypercar, not just the keychains.
Exactly.
And that connects directly back to you listening to this right now. Whether you are a day trader staring at MACD crossovers or a long-term tech enthusiast watching the global quantum arms race, this stock is a masterclass in market psychology.
It really is.
It forces you to decide how to price in the futuristic, disruptive potential of room temperature quantum computing against the very grim present-day reality of cash burn and dilution risk.
It asks you to define your time horizon. Are you playing the volatility of the chart this week, or are you investing in the computing architecture of the 2030s?
But there's one crucial detail we seeded earlier that kind of changes the mechanics of everything we just discussed.
Oh, the wild card.
Yeah. If a stock has a PS ratio of 2,500 and is practically guaranteed to need a capital raise, traditional institutional bears are going to aggressively short it. They are going to bet against it.
Which sets up a massive collision. Because if retail traders and funds like OMERS refuse to sell, the available float of shares shrinks.
Exactly. So I want to leave you with this provocative thought to mull over on your own. With institutional buying surging, founders locking down their shares, and retail momentum defying gravity, are we simply looking at the final exhausted gasp of an overbought market? Or are we witnessing the early sparks of a massive short squeeze?
That's the billion-dollar question.
Because if the bears get trapped and are forced to buy back shares at any price to cover their bets, traditional technical analysis goes completely out the window. And if the quantum revolution is truly here, if Xanadu actually pulls off room temperature computing, does today's price of $48 even matter a decade from now?
It is the exact tension that makes deep tech investing the most dangerous and potentially lucrative arena in the entire market.
And it is the perfect place to wrap up today's deep dive. Thank you for joining us. Remember to like this video, subscribe to the channel, and drop your theories in the comments. Are we looking at a misunderstood monopoly or a devastating value trap? We want to hear from you. We will catch you on the next one.